Welcome to Capital Logic. Most people think they understand how Disney turned a near bankruptcy into a $200 billion empire. They don't. Today we are going beneath the surface to show you what's actually happening. If that kind of analysis is what you're looking for, like this video and subscribe now. Here's what the numbers really say. Walt Disney himself filed for bankruptcy at 21, and his company faced financial ruin multiple times, yet it became a $200 billion empire by relentlessly owning and monetizing its creations. How did they do it? How did they turn near bankruptcy into such monumental success? Stay until the end. I'll break down 3 lessons from Disney's Playbook you can apply to your business this week. If you want business breakdowns you can actually use, hit subscribe and the bell. The story of Disney isn't just about princesses and talking animals. It's a masterclass in survival adaptation and an almost obsessive focus on intellectual property. You see, for all its current dominance, Disney has repeatedly stared into the abyss of financial ruin, only to emerge stronger, wealthier, and more influential than ever before. Let's rewind to the early 1980s. Walt Disney had been gone for nearly 2 decades, and the company he built was adrift. Its animation division, once the envy of the world, was struggling. Theme parks were still popular, but the magic seemed to be fading, and the company's stock price reflected this malaise. It was a prime target, and in 1984, a corporate raider named Saul Steinberg saw his opportunity. Steinberg, through his company Reliance Group Holdings, began aggressively acquiring Disney stock, eventually amassing over 12% of the company. His intention was clear: a hostile takeover. He wanted to break Disney apart, sell off its valuable assets, and make a quick profit. This wasn't just a business dispute. It was an existential threat to the very soul of Disney. The company's leadership, desperate to maintain independence, resorted to a controversial tactic known as greenmail. In a move that drew widespread criticism, Disney paid $297 million to repurchase Steinberg's shares. This wasn't just about buying back stock. It also included an additional $28 million to cover Steinberg's expenses, effectively allowing him to walk away with a profit of $31.7 million. It was a bitter pill to swallow, a costly defense, but it bought Disney time. This period of vulnerability, however, revealed a crucial, often overlooked aspect of Disney's underlying value: its hidden assets. While the world saw an aging animation studio, savvy investors like Steinberg recognized the immense, untapped potential. For instance, Disney's raw land holdings in Florida, the vast tracts surrounding Walt Disney World, were valued at an astonishing $300 million to $700 million in the early 90s. This wasn't just dirt, it was prime real estate, a foundation for future expansion that few truly appreciated. The Greenmail saga, while expensive, paved the way for new leadership. In 1984, Michael Eisner took the helm with a clear mandate: maximize shareholder return. Eisner immediately understood the need to revitalize Disney's core businesses. He reinvigorated the TV and movie divisions, launching the Disney Sunday Movie on ABC in 1986 and ramping up film production with more contemporary content. But perhaps his most impactful move was a renewed focus on animation, particularly musical animation. This led to a string of blockbusters like Roger Rabbit, Aladdin, Beauty and the Beast, and The Lion King, which not only captivated audiences but also demonstrated the enduring power of Disney's storytelling. Eisner also dramatically expanded the theme park division, transforming them into multi-day destination resorts and adding 30,000 new hotel rooms at Walt Disney World. He even pushed into consumer products with Disney Stores and publishing, strengthening the brand's global presence and opening new revenue streams. The company was back on track, but the true transformation was only just beginning. With the company stabilized and its creative engines roaring again, Disney began to look outward, embarking on a period of aggressive diversification and strategic acquisitions that would fundamentally reshape the entertainment landscape. This wasn't just about buying companies, it was about acquiring entire ecosystems of intellectual property and distribution. The first major move in this new era came in 1995 with the acquisition of Capital Cities/A.B.C. for a staggering $19 billion. This wasn't a content play in the traditional sense, it was a vertical integration strategy. By bringing broadcast networks like ABC and the immensely valuable ESPN sports rights under the Disney umbrella, the company gained direct control over programming and advertising revenue streams. It was a bold statement, Disney wasn't just creating content, it was also controlling how that content reached you. But the real game changer, the move that solidified Disney's future as an IP powerhouse, began in the mid-2000s under Bob Iger. Disney's own animation studio, despite its resurgence, was struggling to adapt to the burgeoning world of computer animation. Pixar, on the other hand, was a pioneer, consistently delivering critical and commercial hits. So in 2006, Disney acquired Pixar for $7.4 billion. This wasn't just about buying a studio, it was about integrating the expertise and creative genius that Disney's own animation division was struggling to develop internally. It was an admission that sometimes, to innovate, you need to bring in the best from outside. Iger wasn't done. He saw the immense, untapped potential in other content libraries. In 2009, Disney made another audacious move, acquiring Marvel Entertainment for $4 billion. At the time, Marvel had only released one film in its cinematic universe, Iron Man. But Iger wasn't buying a film studio, he was buying a universe. He recognized the opportunity in Marvel's vast number of characters, approximately 8,000 of them, and the potential for branding them across every conceivable medium. It was a bet on storytelling at an epic scale. Then came Lucasfilm. In 2012, Disney acquired the home of Star Wars for $4.05 billion. This brought one of the most beloved and valuable entertainment properties ever created into Disney's portfolio. Think about that. In just 6 years, Disney had acquired the creative engine behind Toy Story, the sprawling superhero saga of Marvel, and the galaxy far, far away of Star Wars. These weren't just assets, they were cultural touchstones, ready to be integrated into the Disney machine. The genius wasn't just in acquiring these behemoths, it was in what Disney did with them. This is where the counterintuitive strategy truly shines. Many feared Disney would simply absorb these distinct brands, diluting their unique identities. But under Bob Iger, the approach was different, especially with Marvel. It was, surprisingly, relatively hands-off. Disney allowed Marvel to maintain creative freedom, understanding that its success lay in its distinct voice and vision. This trust paid off handsomely. Marvel-related movies alone generated over $18 billion, and this success contributed to Disney's share value increasing from $26 to over $100. This hands-off approach was a calculated risk, but it underscored a deeper understanding. Disney wasn't just a content creator, it was a master of franchise management. The company's strategy is to make the same intellectual property work across film, streaming, television, consumer products, games, parks, and cruises, creating a powerful flywheel for repeated monetization. Take merchandising, for instance. By 2019, Disney was generating over $10 billion annually from franchise-related merchandising alone. This isn't just about slapping a character on a t-shirt. It's about a sophisticated network effect where a new movie drives toy sales, which in turn drives theme park visits, which then drives demand for streaming content. Disney's vertical integration extends beyond content creation to include its own retail stores, both online and physical, allowing it to capture profit from merchandise sales that would otherwise go to third-party retailers. But it's not just the big acquisitions. Disney has a hidden strategy for its classic animated films too, the vault. This practice involved periodically pulling movies from the market and re-releasing them, creating artificial scarcity and leveraging nostalgia. This drove demand and allowed for premium pricing upon re-release. It's a testament to how Disney understands the psychology of its audience and the enduring power of its story. The company's commitment to global expansion also plays a critical role in unlocking IP value. They adapt popular products to local cultures, like feng shui engineers designing Hong Kong Disneyland or Mickey Mouse adorning red and gold national attire. This global reach, often through joint ventures in countries with foreign ownership restrictions, ensures that Disney's IPs resonate worldwide. Disney's brand consistently ranks among those consumers feel most emotionally connected to. This emotional connection is a powerful asset, driving repeat engagement and allowing for premium pricing without aggressive discounting. Loyalty programs like Magic Key use tiered access to benefits, creating an aspirational path that captures revenue across multiple price points. This relentless focus on intellectual property, from its acquisition to its meticulous integration and monetization across every possible platform, has transformed Disney from a struggling animation studio into something far grander. It's become a global entertainment empire built on stories, characters, and experiences that resonate deeply with billions. But how does this empire continue to innovate and expand in an increasingly competitive digital world? And what happens when the very nature of entertainment shifts dramatically? But Disney's story doesn't end with a revitalized animation studio or expanded theme parks. The company, always looking ahead, recognized that the landscape of entertainment was shifting once again. The digital frontier was emerging, and Disney was determined not just to participate, but to dominate. Think about it. How do you take a physical experience like a theme park visit and infuse it with cutting-edge technology to create something entirely new? For Disney, the answer arrived in 2013 with the introduction of Magic Bands. These weren't just fancy wristbands. They were a masterclass in data collection and personalized experiences. For guests, a Magic Band, costing up to $35, became their park ticket, hotel key, payment method, and FastPass all rolled into one seamless device. But for Disney, these bands were a goldmine. They tracked guest movements, purchases, and ride check-ins, providing rich behavioral data for predictive analytics. Imagine the insights, knowing exactly where crowds were forming, what merchandise was selling, and how to optimize staff distribution or alter ride operations to shorten wait times. This wasn't just about convenience. It was about creating an invisible layer of optimization, using AI-driven systems to predict visitor needs and wants. It allowed Disney to personalize experiences on an unprecedented scale, transforming a visit from a series of transactions into a data-optimized journey. But the real game changer, the move that truly signaled Disney's intent to conquer the digital realm, came on November 12, 2019, with the launch of Disney+. This wasn't just another streaming service. It was a declaration of independence from traditional distributors and a direct connection to its audience. The market power of its brand and content library was immediately evident. Disney Plus attracted an astonishing 10 million signups on its very first day. This wasn't just a strong start, it was a seismic shift. Disney was leveraging decades of intellectual property, from classic animation to Star Wars and Marvel, to create an undeniable value proposition. The growth was relentless. By the end of fiscal 2025, Disney Plus and Hulu together had accumulated approximately 196 million subscriptions. Disney Plus alone reached 132 million subscribers. And this wasn't just about subscriber numbers. It was about building a sustainable, profitable business. In 2025, Disney Plus generated $11.9 billion in revenue, a 14.4% increase year-on-year. The average monthly revenue per Disney Plus core subscriber reached $7.81 in March 2026, an 11% increase since September 2024. This pricing power was further demonstrated in October 2025 when Disney increased the price of its standalone ad-supported plan by $2 to approximately $12 per month, and the premium no-ads plan by $3 to around $19. And interestingly, approximately half of U.S. Disney Plus subscribers now select the ad-supported tier, with about 37% of global active subscribers on ad-supported plans as of late 2025. This pivot to direct-to-consumer wasn't without its initial cost to the DTC business, delivered a $1.3 billion operating income for fiscal year 2025, a dramatic improvement from a $4 billion loss just 3 years prior. The strategy is clear. Consolidate Disney Plus, Hulu, and ESPN into a single application experience, reducing user friction and optimizing marketing reach, with Hulu becoming Disney's global general entertainment brand. But to truly understand Disney's ambition, you have to look at the massive investments it continues to make, constantly future-proofing its empire. The acquisition spree didn't stop with Pixar, Marvel, or Lucasfilm. In 2019, Disney made another colossal move, acquiring 21st Century Fox assets for a staggering $71.3 billion. This wasn't just about adding more content. It was instrumental for the development of Disney Plus, significantly expanding its content library with titles like Avatar. This acquisition underscored a core principle. Content is king, and owning the best content across every genre is paramount. And the parks, always a cornerstone of the Disney experience, are receiving unprecedented investment. Disney plans to inject $60 billion over the next decade into its parks and experiences by 2033. That's nearly double its spending from the prior decade. This isn't just maintenance. It's about expanding capacity, enhancing IP-driven guest experiences, and continuing to push the boundaries of immersion. Imagineers are already using AI and robotics, like the robotic Olaf in World of Frozen at Disney Adventure World Paris, to evoke emotion and create experiences that move beyond traditional audio animatronics. The park's experiences and product segment alone contributed $32.5 billion in revenue in 2023, a 16% increase from 2022, largely due to higher attendance and guest spending. Disney's strategy is a masterclass in vertical integration and leveraging intellectual property across every possible touchpoint. The same story, the same characters can generate revenue across film, streaming, television, consumer products, games, parks, and cruises, creating an unstoppable flywheel for repeated monetization. By 2019, Disney was generating over $10 billion annually from franchise-related merchandising alone. This is the network effect of its intellectual property in full display. Globally, Disney adapts, but never compromises its brand. Whether it's feng shui engineers designing Hong Kong Disneyland or Mickey Mouse adorning red and gold national attire, the company understands that global expansion requires both cultural sensitivity and brand consistency. And in countries with foreign ownership restrictions, Disney navigates complex legal landscapes through strategic joint ventures, as seen in Japan and China. The result of this relentless innovation, strategic acquisition, and unwavering focus on its core assets? A company that, despite multiple near-death experiences, now boasts an approximately $180.25 billion market capitalization as of July 1, 2026. From the brink of bankruptcy to a global entertainment titan, Disney's journey is a testament to something deeper than just good business. It's about understanding the hidden power of its brand, the psychology of its audience, and the counterintuitive strategies that allow it to continually reinvent itself. But what exactly are those strategies? And what can you learn from them? Now here are 3 lessons from Disney's Playbook you can apply to your own business. Lesson 1. Diversify revenue streams constantly. You need to leverage your core intellectual property or unique offerings across multiple platforms and product categories to maximize monetization. Think about Disney's theme parks, their cruise lines, consumer products, and of course, their massive film and TV empire, all springing from beloved characters and stories. They didn't just make movies, they built an entire ecosystem around them. Lesson 2. Invest in future capabilities. Acquire or develop expertise and technology your business lacks to stay competitive and open new growth avenues. Disney understood this implicitly when they bought Pixar for $7.4 billion in 2006, not just for the movies, but for the animation talent and technological prowess that had been consistently outperforming them. It wasn't about buying a competitor, it was about buying the future of animation. Lesson 3. Know your customer deeply. Utilize data analytics and technology to understand customer behavior, personalize experiences, and optimize operations for better engagement and efficiency. Disney's early adoption of data in their parks, from FastPass to Magic Bands, allowed them to understand guest flow and preferences in unprecedented detail, leading to more efficient operations and, crucially, higher spending per guest. They aren't just selling entertainment, they're selling a personalized experience. If you want more business breakdowns you can actually use, subscribe. I'll see you in the next one. Now you know what most people never bother to find out about: how Disney turned a near bankruptcy into a $200 billion empire. The question is what you do with that knowledge. Subscribe to Capital Logic for more breakdowns like this one, and hit the notification bell so you catch every episode. The next case study drops soon.